6 investing mistakes that are sure to lose you money and how to avoid them. Welcome to the channel. My name is Spencer and I talk all about investing primarily with ETFs. Now I'm going to be showcasing 6 of the biggest investing mistakes I've seen beginners and expert investors make as we go through this video. I hope you guys do enjoy, and if you are interested in investing, in making money in the stock market, don't forget to like the video and to subscribe. And as always, this video is not financial advice. Let's roll that intro. Now, I need to preface this by saying I have made these mistakes. I have made a lot of mistakes with my investing journey. A lot of investors learn more from their mistakes. I am definitely one of those. I didn't have an education with investing. I learned everything independently from things like YouTube. And so I was awful. For a long time, I was really, really bad. And I'll discuss that in this video and how I've come to develop my strategy now. But we have 6 big mistakes to get to. Some of them higher risk than the other, some more common than the other. So I hope you guys do enjoy, and let me know in the comments what mistakes you've made with investing and how you've learned from it. I would love for the comments to be an area for a new investor to come in and see exactly how to avoid these common mistakes altogether. That's the goal, of course, and the point of this entire video. Using margin or high risk is mistake number 1. What we're seeing here are 2 screenshots that are from Robinhood accounts where one user lost $374,000 and another lost $103,000. These are insane amounts of money. We can see the user on the right is using options, and wow. I cannot imagine having that amount of money and losing that amount of money. So what is margin? For those that don't know, margin is basically borrowed money. It is debt. You're using margin to purchase stocks in hopes that they go up, but you pay a fee to do that. So you're paying a margin fee, and it's really, really risky. I've seen a lot of accounts absolutely blown up by using margin, and then they get margin called where they have to pay the money back and they don't have it. And it is very, very destructive. High risk would be things like not diversifying. I initially was over diversified. I had mutual funds and that was it, very low growth. And they performed as they were supposed to, but I needed more. So I actually am technically a little bit of a higher risk investor now, but a high risk investor, let's say someone that only buys Tesla and holds it, or any single stock, really. Tesla is a higher implied volatility stock, but not having a nice safety net, not having diversification for in case the one stock you're holding falls or terrible news comes out. We've seen Tesla fall 40% in some instances. So if you lost 40% on your entire portfolio, that would be destructive. So first one, again, using margin and high risk. And it is something that I see more new investors use. People think that you can use margin and leverage money and use options and make $1 million when you're 20, because some people have done it. And I will say there are people that have had success with that strategy, but 99.9% of them fail miserably. And it is definitely a way a lot of content creators will actually showcase, look how much money I've made using options, where they're using a portion of their portfolio or they have a lot of money in the bank. And so it's not as high risk for them, where someone that's putting their life savings into something to try to become a millionaire, higher risk. So always remember that. Remember who's making the content on these things. And if you're a new investor and you're considering, diving into the world of options, I recommend learning options. It's fun. It's something you can do. There are safe and high risk options formats as well. But do everything carefully. Be careful, and of course, not financial advice. Number 2, yield versus total return. Now, on the right, we have ULTI, YieldMax's Ultra Option Income Strategy ETF, which I've made a lot of content about. At one point, it was the best weekly paying dividend ETF, and it was yielding about an 80 to 90% distribution rate. But there is a difference between yield and total return. And people seem to mistake that. They'll say, oh, but it's yielding 90%. I'm making so much money, but total return is different. And while ULTI still had roughly like a 30% total return when I was holding it, I actually still hold it. I should check currently what it is. But at its peak, it was, I think, up 36% total return. It was never up 80 to 90% in the portfolio. That's what it was yielding. So remember that. And now we can also see on the left side, $100,000 invested in high yield bond fund ABC. And you can see price return and total return, which is including distributions. So yield does help, but you get yield at a cost. And I think a lot of, especially ETF investors, that misunderstand yield and distribution rate is how you would define it for ETFs. You get kind of mixed up because, oh, it's yielding this, the distribution rate's paying out so much money, but you are paying a cost for that. It's the same thing with dividend stocks. And so that's one thing that I have to remind myself consistently, dividend stocks, I do like dividends, I like income, but what you're missing out on is the growth aspect of that. Because there are tax benefits, but because a company is paying out a yield or a distribution rate, it's not reinvesting back into the company for growth, if that makes sense. So REITs, for any number of things, like realty income, let's say, if they never paid a dividend, they wouldn't be as popular, of course, but if they had never paid a dividend, how many more properties could they have to increase their bottom line, to increase their revenue, if they weren't paying investors a yield? Now, again, I don't think it would be as successful as they have become the monthly dividend paying REIT. But that's something to think about. Everything comes at a cost. Nothing is free. You're not going to pick an ETF that's going to get you 90% on an annual basis. And even if it does get you close to that over a couple month period, I don't want to say all good things come to an end, but it's not likely that it will continue that trend indefinitely. So yield versus total return. Yield is what they're paying you. Total return is what you end up getting with your initial cost basis. So if I have Ulti and it's yielding 80%, but it drops 30% a year, my total return is not going to be 80%. It's going to be in the 50, which is still very good, but it could be more depending on the drop in the overall price, depending on the yield, of course. So remember that. That is lesson number 2, something that I mixed up initially with these ETFs. And I understood it, but not to the full depth in which I do now. So I hope that that was a good explanation and that it makes sense. Oh, I love this one. Timing the market. This is a huge thing, and I have to catch myself over and over again to stop myself from trying to do this. Because let's say, for instance, right now, the stock market is at what, all-time highs. The S&P 500, the NASDAQ, they are all pumping so high. And I know that there will be a pullback. Let's be honest. It doesn't always go up. It usually goes up, but not always, and it's usually almost always in an upward trend once you zoom out a little bit on the chart, of course. But we will see a pullback. And so what I try to stop myself from doing is selling out of my investments simply because I'm worried about a pullback. So what this chart is, it's very, very important. This is the impact of just missing the 10 best days in the stock market. 10 best days for the S&P 500 specifically. So you had $10,000 invested in 1989 and it grows all the way to now. So if you had missed just those 10 best days, you'd have $150,000 from your $10,000 investment. If you hadn't sold out because you thought the market was going to drop for any number of reasons, $329,000, you more than doubled your money because those 10 best days are huge. Absolutely huge. And what we see on the chart here is it's because of this main drop right here where people would sell out immediately and then you'd miss the crazy rebounds. So what I do, and my strategy is, this is only lesson number 3. There's so many mistakes you can make with investing. So I hope this video is helping and reaching the target audience. If it is, guys, don't forget to like the video and to subscribe. But the way I do it, and the way a lot of investors that I know do it, is you just hold cash. So on days where the market drops 5%, so for the S&P to drop 5%, it's a terrible day. I buy more. That's just the way that it goes. And it's hard to do because you may go, oh, it's going to drop 10% tomorrow, but you never know. And again, that's not financial advice. It's just a way of holding cash to try and dollar cost average or average down your positions. This is a hard one, and it's a very hard lesson to learn. And I still swing trade. So swing trade and timing the market are a little bit different, but I still like to buy and sell. I try to buy lows and sell highs, of course, as is kind of the average of what investors are trying to do when you swing trade. But to remember this main factor, missing the 10 best days in the market will cost you insane amounts of money and will significantly impact your portfolio. On to the next. Listening to YouTubers. All right, I know this might seem like friendly fire, but hear me out. First of all, it's a very blurry image of Caleb Hammer. I love Caleb Hammer. This is not to slight Caleb by any means. He has a great channel. It's called Financial Audit, I believe, and I listen to his podcast all the time. And he does like breakdowns on spending and has people on his show, and he kind of like goes, why are you spending $10K a month making $5K a month? Stuff like that. And he's very harsh, and he has a very good business model with it. He makes a ton of money with it. He is harsh, and sometimes he gets in hot water with contestants getting upset with him. And now over to this Jeremy Lefebvre, I believe is his name, and I put him on here. I was requested to do a sponsorship with his business. I'm not going to list it. I'm not going to say it, but it was outrageously overpriced. So as you guys know, I cannot stand pushing stupid content and stupid ideas and stupid sponsorships that I think have zero value. And I thought that one had zero value, and it's how he makes a lot of money. Just so you guys know, I believe it's $1,000 a month, the program or whatever he was selling. And it was literally like FinViz. FinViz is a free stock screener, and I think it even had less. I used it in one video on the small channel. I think I even took it down because it was so bad and so I couldn't like it. And honestly, no shade. He's chasing money, and that is what a lot of YouTubers do. But this is the exact thing. Do not listen to YouTubers. And I'm going to be honest, I strongly dislike this thumbnail because, first of all, I don't understand how it's not financial advice. You could say it's not financial advice. He's saying to buy this now, and new investors will do it. And that was me. When I started investing, I started with YouTube, not making content, consuming content. And that's a huge portion as to why I make content on YouTube now. Just so you guys know, if you're not in the YouTube space, you can make so much money. You can make so much money from stupid videos, from stupid sponsorships. And sometimes it's hard to say no because they'll offer insane amounts of money. And I'll give an example of that in 1 minute. But this is I think it's awful. First of all, it's just a poor thumbnail. It's poorly done. I'm a little bit pickier with my thumbnails, but this guy has hundreds of thousands of subscribers, so people are watching his content, but new investors are watching his content, and they're making him insane amounts of money. And I'm not saying thousands. I'm saying hundreds of thousands to millions of dollars. And they're buying his program or his whatever he's selling, and they're buying this stock. So this is probably a penny stock that he's saying will 5x buy now because it gets clicks, it gets views, and it gets views primarily from new investors because investors like you and me primarily aren't going to look at this and go, oh, let's buy this. It's going to 5x. I'll buy it right away. But I used to do that. So there was a channel. He still makes content on here, and I'm not trying to throw shade at anybody. Moon Market is the name of the channel. And I liked the guy. of course, it's my own fault. I'm not blaming anybody else. I consume the content. I purchased the penny stocks. Moon Market's a penny stock. He talks about things that are going to double, triple, quadruple, 10x. And I bought about 5 of them, and they all tanked. I think I lost 99% of my investment on most of them. And like literally when I say tanked, I mean tanked. Like immediately going from like 7 cents to under a cent where you can't even sell it anymore. And it was destructive and it was terrible. And I learned my lesson very, very quickly. But wow. It was awful, and it's still kind of pushing and peddling that content to new investors who don't understand. And so that's again why I'm making this video. But let me just explain to you how the sponsorship programs work. So I've had 2 sponsors in the last month reach out to me for content. One offer, I'll tell you the prices. One offered me $1,200 for an in-video ad of 30 seconds, which let me tell you is insane. They're paying $1,200 for me to make a 30-second clip to include my video. And there's reasons why they do this. The other one offered, I believe, $900 for the same style thing, 20 to 30-second video, clip in video. So the reason I don't do those is because, well, I looked up both those providers and they were crypto, which is already a red flag. You have to vet crypto specifically because people are just scamming like crazy in the industry. But what I did was I looked them up, and the reviews were it's a crypto trading app. It's kind of like Robinhood, but for just cryptos, and you store your money in there and blah, blah, blah. The main complaint was about 40 to 50% of people couldn't get their money out of the account. So imagine having a bank account that won't let you take money out. What's the point? Exactly. They were scams. But you have to really search and find if they are scams or not, because I don't want to miss out on a good sponsorship that I think could be beneficial to the channel. But at the same point, I'm not getting you guys scammed because nothing makes my blood boil like scamming. It genuinely does. And you might say you're in the wrong industry. And I am. YouTube is full of scammers. Caleb Hammer is not a scammer. I want to reiterate that. But listening to YouTubers could cost you a lot of money. And there's one main reason for those that don't know. I'm a little more long-winded on this slide because I'm very passionate about this. It's, again, the reason I started my channel was because I lost so much money listening to YouTubers, and I wanted to help people learn and better understand investing. And so that's why we're here. And I talk about all things. I talk about high-risk investments as well, but I'm never going to say, buy this, it's going to 5x, because I think that's a terrible thing to do to your audience. So I hope that does make sense. I don't buy courses. I've never bought courses. I will never do a course on selling ETF information. I just won't do it. What's the point? I make money from YouTube. These people that are doing this, if they're selling e-guides, I've seen a lot of ETF issuers selling ETF content creators selling e-guides. I think it's I think it's terrible. I do. A lot of them make more money off their e-guides than they ever will with their investments, and that's something that they don't want you to know. And that's an important thing to know, that you are the product. They are not making $100,000 a year off of their investing strategies. They own one growth ETF. They are making money off of you. The same thing with coaching calls. We are not financial advisors. I don't love the financial advising industry either, but we are not financial advisors. We don't know your certain instances. We don't know the legal side to it. We don't know what we can and can't say. There's the SEC, there's FINRA, there's all these things that prevent us from doing that, and for good reason, because you can get scammed unbelievably easy. And I've seen and even talked with creators that I do believe scam people 100%. They sell coaching calls for however much money a month, and you get to talk to them for who knows, 20, 30 minutes, where you basically are just talking with someone who they don't know. They don't invest the same way you invest, and they'll pretend that they do. They do not. So I'm big against courses. I'm really big against channel memberships. Can be used in a good way. I have channel memberships up. They're literally just for if you want to support. I don't push it. I don't mention it in videos because I want you to invest your money and make more money with it rather than, buy a channel membership. But I do appreciate channel members. Thank you guys. I am very grateful to you guys. But again, save your money. Save your money. If you're watching this and you're learning investing, chances are you'll make more utilizing that in the stock market, and my content is going to remain free regardless. So don't buy courses. Don't trust all these scammy YouTubers. It doesn't matter if they have 500,000 subscribers. They will scam you. They do not care. That's just the way it goes. So on to the next. And there are some, I will say, there are some big YouTubers that I think are absolutely phenomenal, like Caleb Hammer, for instance. All right, emotional trading / day trading. Emotional trading cost me a lot of money. It's basically meaning, I don't want to miss out, FOMO. And this is a perfect chart. So we have a stock. Here's the price. Here's what it's doing. So it starts going up like crazy. And you go, I want to buy in. It's going crazy. So you buy in, it goes up 10% and then drops 60%. And you say, it's going to keep going down. So I sell. And you panic, sell that, and then boom, it goes back up. And this is actually wrong because you've exited here and then you exit. I guess they have it exiting at 2 points where you sell some, you sell more as it goes up. And that's the case. So emotional trading is an interesting thing. It's hard to get over, but if you're a buy and hold investor, like I am primarily, with some swing trading as well, it is something to definitely learn. And then we have day trading. $9,000 day trading loss. Guys, I see more day trading courses than any other kind of course, and it drives me up the wall. Day trading, not only is it probably one of the highest risk things you can do, but there are people that will say anybody can do it, and it's not true. It's not true. You have to be a specific kind of person. And I'm going to preface this. There are people that make a living day trading. They are good at it. They are experienced. They know how to do it, and they can do it. Most people can't. And it's one reason why I'm a big proponent of not buying into these courses that cost $3,000, $4,000, sometimes $5,000 to learn to day trade, where that investment is 90% of the time not going to get you your money back. And that's the thing, is these people selling these courses, and I should say content creators, YouTubers like myself, selling things like this, they straight up have made their profit the minute you click buy. They don't care what happens to you. They don't. It's not them losing money. Of course, they probably want you to succeed rather than fail, but they've made their money and they're done. So I don't like that. I don't like day trading. I don't like pushing day trading on young people. I had a friend once reach out to me and he's like, hey, you're doing content on YouTube, yada, yada, yada. Tell me about it. I'm really interested in day trading. And I said, well, he was young. He's in college. I said, don't. I literally said, don't day trade. It is not something that makes sense. It's not something that you can do long-term, especially as a full-time student. It's not something that's easy to learn. It takes a lot of practice and a lot of capital to start. And I said, here's what you should do. Open a brokerage, open a Roth IRA if you have earned income, and put that money in there and let it grow over the next 30 years. And he was like, well, I want to make a lot more money now. And I said, that is what everyone wants to do. We all want to make a lot of money now, but unless you're going to start a YouTube channel and start absolutely scamming people, you're not going to make tens of thousands of dollars a day with day trading, especially starting with, he had a couple $100. But it was good. And we did talk about it more. I'm not sure if he ever did try day trading. I don't think that he did, but it was good information. So day trading, emotional trading, you have to learn it. And there's a lot of high risk with day trading. And there's a lot of losses I've made with emotional trading, things like FOMO and whatnot. And I've also missed out for the opposite, for emotional trading the other way, where I didn't buy NVIDIA because I was like, it's already so high, and it kept going. It just kept going. So there are goods and bads, but there's probably one NVIDIA to 1,000 other stocks that did really well and then tanked. So remember that. Remember your chances. All right, we're on 6. This is tip number 6. Not starting is one of the biggest problems. Here's the power of compounding interest. This is from Dave Ramsey's website. So we can see Ben starts investing at age 21 and he stops investing at age 30. So he's invested for exactly 9 years. And in that time, he has put in, it doesn't specifically say how much money, it looks like probably $40,000, something like that. Over that time, he grows it up to $2.1 million by age 67. I have a number of problems with this, but I will talk about it. Then we have Joey, who starts investing at age 30 and invests the entire time, the same amount, probably maybe even a little bit more. And because he's losing some of the compounding interest, he doesn't start from 21. He starts at 30. He's lost 9 years. He is only at 1.2 million, which is still absolutely phenomenal. The issue with this is it does show the power of compounding interest, which I am a massive fan of. Who was it? Was it Buffett that said compounding interest is like the eighth wonder of the world? And I truly believe that. It is. It's absolutely amazing if you can start young. The problem with this chart is it has people retiring at 67. And when I turned 67 in, I don't know, 29 years, 39, how old am I? Oh my gosh. You ever get that where you just forget your age? No, it'd be 30 years, something. But anyways, when you get to that point, when I get to that point, are we going to be able to live off of 1.2 million? Because I feel like with how inflation's going, we probably won't. And even in 40 years, it's going to be worse. It's going to be better. Or is housing going to be more expensive? Is it going to be cheaper? Who knows? So that's the main part of this potential slide. Is this one could probably make you the most money. Starting early and get going. And guys, it doesn't take a lot. It really doesn't. Opening a brokerage can be complicated, but there's ways you can do it that are simple. There's simple apps like Moomoo and Robinhood that make it relatively easy. Now, I want to specify, I'm going to be doing a course. Isn't this funny? I'm doing a course after saying courses are scams, but it's free. So what I'm going to be doing is I'm going to be doing a YouTube series with my fiance. We're getting married in a couple of weeks now, and we're going to be doing it actually on our honeymoon because she's very excited to film. But please be nice to her. Hasn't been on camera ever before. I know you guys will. You guys are absolutely phenomenal. But we're going to do an intro to investing course. I'm going to teach her how to invest. And I think it's going to work really well because she has no idea. She knows I make investing content. She knows what ETF kind of stands for, and she understands the stock market a little bit, but I'm going to be basically teaching her in a one-on-one way that's going to showcase exactly how to invest. We're going to use things like the power of compounding interest, explaining ETFs versus stocks, growth versus income, the different indices, all sorts of things. That's going to be diversification. And so I'm going to show her. We're going to sit down and make probably 30 to 45-minute videos. And we're going to do probably a 6-part series, I think, where they'll be a little bit longer, but an intro starting from bare bones beginning of investing for someone who has never really learned it at all. That's what we're going to do. So I hope you guys are interested in something like that. Let me know in the comments if you are. It won't be as targeted towards my typical audience of ETF investors who are familiar with a lot of the language, the lingo, and know this stuff. Some of you, a lot of you probably even better than I do. So it'll be more towards the newer audience, but I want to kind of split and get some new people interested in ETF investing as well. But that is it. That is the end of the PowerPoint. That is the end of the video. I hope you guys did enjoy. Again, don't forget, if you're interested in becoming a better investor, to like the video and to subscribe. And if you liked this, check out these videos popping up on your screen right now. I really do hope you guys learned something. Let me know in the comments what your biggest struggle has been with investing, and I hope to see you in the next video.